Okay, so the next order of business is real estate solutions. Patty?
Here. I think I'll stand here if that's okay. Our job was to complete an objective analysis of the proposed project, much like a bank would do or an institution that was going to finance a project would do. So we looked at the market, we looked at what's inside the building to understand what drives the revenues in comparison to what's in the marketplace today and what has happened historically. So in the project are 7 townhouses, and some of this is a little bit different than what was proposed before. 400 rental apartments, 109 condominiums. There are approximately 317 parking spaces. There's indoor retail of 12,000 and outdoor retail of approximately 8,000 as well. And then within the building there's some amenity space, most of which doesn't generate revenue. So what do? We took an objective view of the financial projections that were provided to us by the developer and looked at the assumptions that they provided in their financial projections to understand what was driving the revenues and his returns, as well as the gap that Mr. Fane noted. We looked at rental apartments, the retail, all these things that drive revenue, parking, the sale prices of the condos and the townhouses, and you also have to look at the vacancy rates as well and absorption to understand how the project is going to perform. We also looked at real estate taxes. How do we do this? We interviewed local property owners, we talked to brokers, we went and visited comparable sites, we looked at all the market, we looked at what was coming online and what was proposed so we understand what the competition is. Most of this was done back in December when we did our earlier analysis, but we did do a lot of updates because the condos and the townhouses were not in the original project, so we did do some market due diligence on that. We also communicated with Mr. Fane and his organization to ask questions, to get clarifications on certain issues that we didn't really understand. They were helpful in that regard and responded to us. So based on all the information that we obtained, we did an adjustment to the developer's assumptions in their pro forma. I don't want to get overly technical here, but so we adjusted some of those assumptions to reflect what we believe is the market based on our due diligence. And we looked at a metric called return on cost. And what that is the net operating income that comes out of the project as compared to the projected cost of the project, which in this case was $220 million. And then based on that, we looked at what the potential financing gap is. And we're not saying that Mr. Fane will ask for this. We're just saying that if an investor were looking at this, there's a risk that if you looked at it from more of a market standpoint, that the returns might be much lower and there might be a larger gap. So there are ways to solve that, but that was our job. Next one, please. So some of the concerns and adjustments that we made, one of the concerns is that the units are much smaller than what's available in the marketplace today. And there is a trend overall in urban locations for units to become smaller. These were 50% smaller in most cases. For the townhouse, based on the market, we understand this will be a new project. We placed a downward adjustment of $500 per square foot. For the condominiums, we adjusted to a maximum of $800 per square foot. For the parking sale prices, we assumed that those prices would be included within the sales as opposed to in addition to. The rental rate for the indoor space, we adjusted downward $7 per square foot. And the outdoor space, we did not assign any kind of rent to because based on our due diligence in the market, brokers and owners felt that you couldn't really charge anything for outdoor space since it's so seasonal. Next one. The parking rental income, which is different than the parking that comes with the units, we adjusted down with $50 for the base, and for the long-term vacancy, we adjusted that to 10%. Operating expenses, we increased and increased it to $6,700 per unit. So that's increasing at 3% per year over the operations of the building. Next slide, please. So we looked at the return on cost, which we discussed. And when we did that, we compared our estimates with our adjustments to what the developer estimates are. The developer estimated that their return on cost would be 6.99, which you'll see is in the range that's acceptable. But ours resulted in a 4.71%, which is below the range that's really acceptable in the financing markets today. Next slide. So depending on the location, the level of risk with a project, the size of the project, the competition, the institutional investment market considers a range of acceptable or return on cost 6.2 to 8%. That's in today's market. So the developer's estimate on their own does fall within that range. The issue for us is that we feel that some of those assumptions are a little bit too high and optimistic, which will result in a much lower return. So the chart below shows that if you look at what a return of 6.25, 6.75, 7.25, what would happen using our numbers in terms of the kind of gap that would be produced. So you can see the numbers are much higher than the 18.5 that would be requested by the developer. So this is a way of looking at the project in terms of understanding the potential risk. So we're not crystal ball people. We can't say that this is exactly what's going to happen, but you do have to look at the market that you're located in and understand how it's performing. We did give the benefit to the project of being on the high side because we understand this is a new project. It's going to have very high apartments with beautiful views. So we weren't as conservative as we could be. I'll go to the next slide. So we identified the risks for the project, aside from the potential financial risks of being able to finance it due to the potential gap. As everyone's discussed, the timing of construction is a risk because if you have to extend the period to get permitting approvals, what often happens is the carrying costs increase, interest rates increase, project cost increase, so that's a potential risk as well. The absorption, we feel, is a risk. About 291 units are absorbed in the market historically to date. So that means that since this is projecting a 1-year occupancy basically for all the units, we're talking about the rental units, that they really need to absorb the majority of the market. So that's risky. Could a new building do that, and could the market expand in the future? Absolutely, but it's a risk. Because these units are so small, anything with smaller than 2 bedrooms don't have a laundry facility in the unit. Now that's common, but the issue here is that it's a luxury building and it just might make it less competitive than some of the other properties that are being built that do have that. Construction costs can always go up, unfortunately. Until there are final drawings, until the building has been specifically designed, there's a risk that construction costs could increase. The demand for 2-bedroom and larger units could be there, but these are smaller. So we're just questioning the size of the units and the ability to absorb the units in the marketplace today. There may be a higher vacancy than what's projected. We did not factor that in. I'll just go a little bit. Appleseed is another company that we work with who did an economic impact analysis, and they use a model called InPlan. What they determined based on the project as it's proposed is that there would be 958 person years of construction. So that means for each job, it's a year of employment, which is for Rhode Island jobs only. Building operations, once the building's up and it's operating, there would be 19 jobs. Residential projects don't employ a lot of people. and that's just the way it is. So it's the management that's on site, and associated operations with the building. Retail is a range of 44 to 57. The reason for that range is 57 assumed that it would be all restaurants, which have a higher employment level. 44 assumed that it was going to be a mix of different kinds of retail, which it sounds like it will be, not just restaurants. Questions?